to the Stockout. This is your show at FreightWaves for all things related to the CPG and retail industries. I'm your host, Mike Bowden-Distel. Grace Sharkey is out, so it's just going to be me today. So it's not going to be as good as it usually is, but what I have for you today, some interesting topics. I think we have some new offerings in Sonar that are relevant for shippers, which shippers are the intended audience of this show, although I'm happy to have anyone who's not a shipper as well. I'll talk about the freight market a little bit. I'll talk about the activist situation at Norfolk Southern and what that means for shippers. There's no longer a show called People Speaking Rail, so I'm going to have to speak some rail here. And then I'll talk a little bit about an update on the Amazon marketplace, which I think there's some interesting developments there that could really potentially be pretty impactful. Before I do all of that and hit those four topics, I want to encourage everyone who's not already signed up to sign up for the Stockout newsletter. So I send out a Stockout newsletter, which follows some of the same topics here, some others, just whatever I find interesting. The way to do that is to go to www.freightwaves.com/the Stockout, or just go up to freightwaves.com. Up at the top under newsletters, it's going to be the first one there under supply chains. So it should be pretty easy to sign up for that. Also happy to talk through any additional topics that people have in mind that they'd like to see me cover. So with that, I get into the first topic today. Is Sonar releases some new data series, which I think are important for shippers. I mean, I think maybe the intended audience was the brokers, but I think it's relevant for shippers as well. And so Sonar releases a national Reefer spot rate index, the RTI, as well as a quick rates tool. And so the idea behind a national spot rate index, and this is what we're looking at here. So this was just released on Friday. This is a national average of Reefer spot rates, and those are going to include fuel. And so this is just kind of, if there's one data point to look at and you just want a quick and dirty average, this is going to be it. Looks like it's $2.77 a mile, and you can see this is about a 2-year chart, 1.5-year chart. You can see those are lower than they were, at that period of time, of course, but it's actually improved, somewhat in recent months. Kind of now the 277 range, and you can talk through a little bit about. So it's kind of why that is. And so we also released a flatbed spot rate index. I think a lot of retailers are into the spot rate, the flatbed. The reefer is more relevant for them. And now this chart, what we have here is in white is that RTI, that reefer spot rate index, and then the purple is the reefer tender rejection rate. And the idea is that tender rejections do tend to lead changes in the spot rate. Changes in the spot rate tend to lead changes in the contract rate. And so you want to pay attention to all those things. But in particular, I'd say the more leading indicators, which would be things like, tender rejection rate, tender volume, and that typically leads to, changes in the same direction for spot rates and contract rates. Those are the market that a lot of these shippers, participate in, that contract market. And so you see that, in the recent months, some of these rates have risen. It seems like maybe we're getting into a situation where there's some support for contract rates finally. Also launched, in addition to those nationwide indexes, launched a quick rates tool. And the idea behind quick rates tool is this can be very similar to the calculator function on your computer, where I think I use that probably 10 times a day. The calculator function on the PC, just to do a quick calculation, or I think on a Mac, it's Command Spacebar, gives you a way to just do a quick calculation. So similar to that, we have a tool which you can have, even outside of just Sonar. If you have too many things open, if you're a broker or even if you're a shipper, can kind of keep this and just have a real quick and dirty way to calculate a rate. Here, we're just, all you do is type in your origin destination. I'm not sure what is being moved from Chattanooga to Las Vegas. The person must have been excited about the Super Bowl, despite the fact that it's a really lame matchup this year. But it's a quick and dirty way to get at a spot rate. It gives an option to actually having to go into Sonar and do your two-factor identification, all of those things. So would encourage you to reach out. If you're a Sonar subscriber, reach out to your customer service representative, customer success representative, and have them get you set up with that. There's also, for those interested in Reefer who are interested in that Reefer spot rate index, are also going to be interested in a show that Mary O'Connell did the other day, which was on Reefer cargo theft. So just wanted to highlight that as well. And I think all that discussion on Reefer spot rates gets into the next topic, which was a good article that Zach Strickland wrote over the weekend. Spread narrows between contract rates and spot rates. And that's one of the reasons why we want to have spot rates in Sonar as a nationwide index. Now, no one ships the spot market for the entire country. You ship spot market on a particular lane, but we have series in there that shows contract rates for the whole country as well. And so when you compare those rates, it gives you some sense of where the contract rates are headed. And so in this article, Zach asked the question, what do we learn from the spot to contract rate spread? And next Sonar chart here shows that there's been a tightening in that spread. And so basically what we're looking at here is the blue line van tender rejection index, and then the line that's red and green. When it's red, it means that the spot rates are below the contract rates. That period where it's green is the contract rates above the spot rates. So really since the beginning of 2022, the spot rates have been really significantly below the contract rates, more so than they would typically be. And they've kind of hung out at a really low level. Would say that most of the time the spot rates on average are going to be below the contract rates on average, because the spot rates reflect a lot of backhaul lanes, sort of carriers taking brokered loads that don't pay very well, and those seep into the average. But it's pretty significant when you see that this spread that had been, let's call it 60 cents a mile, 60 to maybe 70 cents a mile for a year and a half, has tightened a little bit to 38 cents. So it does seem like the spot market is tightening up just a bit, which, if you're a contract, shipper, maybe you're thinking that the contract rates, if you got a price cut recently, those are going to be the last cut in the series. There's another Sonar chart here that shows van contract rates versus the spot rates. And so this is looking at it a little bit differently, comparing it to different data sources. But so here, made the case a moment ago that the spread between contract rates and spot rates are narrowing. And, then begs the question of, why are they narrowing? Is it because van contract rates are declining or spot rates are increasing? And you can see pretty clearly here, the spot rates are in yellow. Those are increasing. The contract rates sort of flattening out. There is a little bit of a timing difference where those van contract rates are on a 2-week lag in white there, and the spot rates, that's a daily data series. So it is, possible that the van contracts change in the next 2 weeks. But, typically, you would look at something like this and say, well, is this being driven by seasonality? I think that was part of the case that Zach made in that article, was that seasonally, this is a weak time of the year for the freight market. So wouldn't expect spot rates to be rising, simply because of the seasonality. If anything, it should be weak because of the seasonality. It does seem like it's related to, capacity starting to come out of the marketplace. There was another article that John Kingston wrote the other day, talking about the change in transportation employment and how that was down from a year ago. And certainly there've been lots of job cuts at various brokers and all those things. But, the biggest segment of transportation workers is drivers. That's a pretty good indication of total transportation capacity. So when you see those down versus a year ago, does give an indication in one way that capacity is coming out of the marketplace. So the question that Zach poses in this article, what can we learn from contract spot rates to contract rate spread? I think it does give some indication that maybe contract rates have reached a bottom, that maybe we're a little bit closer to market equilibrium than you would typically than you might think. It's kind of a situation where there's still capacity out there, but it's maybe getting closer to being in equilibrium. And you always have to look at this in the context of where we are seasonally, and if something is happening that's contrary to what's happening, what typically happening seasonally, it's more relevant. I think that's the case here. So we try to you can hear more about that from Zach when he does his Freightonomics show, which I understand is the second most listened to show on FreightWaves behind What the Truck, and I think that goes out Wednesday or Thursday. So you'll hear more about it then. But with that, check out the article, and want to move on to our next topic, which is a topic I could speak about all day, railroads and investors. So the question is, will Norfolk Southern's activist situation lead to service disruptions? And the stock was strong on a Thursday. So this report came out Wednesday night or Thursday morning that Norfolk Southern has activist investors in the shares. Norfolk Southern has been struggling. There was some speculation that you would have an activist situation. It was sort of confirmed. This activist fund, Encora, reportedly has a $1 billion position in Norfolk Southern shares. It doesn't seem like they're the only activists. There seems like there's a couple others that are also pursuing some of the same objectives. And some of those objectives are they want the CEO, Alan Shaw, to be replaced. So that's the same CEO that went through all the turmoil last year with the East Palestine derailment. I'm sure that derailment took years off of his life. This activist situation it probably takes even more, just as stressful as dealing with the derailment. But it's essentially the operating ratio has lagged the peer group. So it's a very sort of well-worn playbook that when Class 1 railroad has an operating ratio that's worse than the peer group, activists pile in, say this is the one that's undervalued. They try to get them to take costs out of the cost structure to improve the operating ratio, improve the earnings, et cetera. And so investors are excited when there's an activist investor in the stock. And when that news came out, Norfolk Southern shares were up 9% on Thursday. On that day, it was the third highest gainer in the S&P 500. And so it's good for the stock after a weak quarter earlier last week when Norfolk Southern reported. John Kingston did an article writing up that earnings report from the site. Really got to the crux of the matter, where all the analysts ask, why can't you be more like the other Class 1 railroads and have a better operating ratio? Was kind of the crux of that article. Same argument that the activist investors are making. But so investors are excited about it, but from the perspective of the Stockout, which is retailers or CPG shippers, I would be concerned if I'm an intermodal shipper and I see this activist situation, just because the pressure is going to be to cut personnel, to maybe reduce the capital expenditures. All of those things could hurt intermodal service levels. And the intermodal service levels, you go back a couple of years and they were just dreadful. In the past, several months, they've been a lot better. I've heard from CPG shippers specifically that they've been using intermodal more, specifically because the service levels have improved. I heard the opposite, going back a couple of years, where they were pulling some of their containers out of intermodal terminals and trucking them because the service was so bad. So I see this, and the pressure, whether it's the current CEO or they replace Alan Shaw with somebody else, they're going to replace him with someone who's probably a cost cutter. So I would be concerned about the service levels. I also be a little bit concerned if I was JB Hunt or Hub Group, which both rely on Norfolk Southern in the East for the rail service, because that really directly translates to whether or not intermodal has a good value proposition. Is not just getting a discount to the highway. Is it a consistent service? Is it consistently truckload plus a day or a truckload like service? So if anything, I would be a little concerned about that. One way to monitor that in Sonar is the O-Rail, what we call the O-Rail DOML ticker for outbound rail container volumes, domestic loaded. And so what we're looking at here is specifically a lane that Norfolk Southern is going to run in heavily. So this is Chicago, southbound to Atlanta. And you can see that big kind of dip and then surge in white in 2024, which is related to the winter weather. But late last year is in, you see blue was 2023, and you see how throughout kind of the third quarter into the fourth, that was pretty nicely above the previous couple of years. The reason for that is the service levels improved. I heard directly from shippers that were using that lane a little bit more heavily than they were, citing those improved service levels. So one way to monitor, service, it's hard to monitor rail service from the outside, perfectly, because there's a lot of metrics that are maybe less than perfectly helpful. Things like, speed or terminal dwell, which doesn't tell you whether it gets there consistently and on time. But when you look at the sonar data for containerized volume, I think this speaks to whether shippers are finding value in rail intermodal if volumes are strong there, and if the service is poor and they use more on the highway, you will see a dip here. So this is not strictly demand. I think it's also there's a pretty significant service component in that. So want to move on to talk a little bit about Amazon. And Amazon, we've talked a lot about Amazon in the show, which makes sense. I mean, the e-commerce giant, they're about 40% of total e-commerce. And there's this question of, should Amazon be responsible for everything it ships and sells? So typical consumer goes to Amazon.com, they buy something. I don't think they give a lot of thought to whether they're buying that from Amazon itself or a third party. But about 60% of the revenue is from a third party that's making use of what's called the Amazon Marketplace. And that's most products that are not, a Kindle or Amazon Basics or something that's private brand. It's these third party companies that are in business for themselves that you will, use an Amazon fulfillment center to get their products distributed. And so there's this question now of, should Amazon be responsible if there's some product that is sold on Amazon that was from a third party that is either defective or doesn't have the proper warning label, or is just dangerous in some way, has some paint that chips off of it? Is Amazon exempted from that because they're just a marketplace and it's the seller, the supplier's responsibility, or does Amazon have a responsibility there? And there's potentially this order coming from the U.S. Consumer Product Safety Commission that could classify Amazon as a distributor, and that would make it liable for third-party products, for the safety, for all of those things. And that could potentially open up Amazon to lawsuits and extensive recalls over items that it doesn't have to deal with now. And it's really not always clear to consumers whether they're buying something directly from Amazon or from third party. It's always something that the reason I haven't liked Amazon for a lot of products is there's a certain lack of quality control, I think, there, because so much of it flows through the third party sellers. And I think it's obvious if you don't get the buy box and it's like, shop other options for this product, which almost every time that comes up, the consumer doesn't buy the product. The consumer tends to buy the product only when they get the quote unquote buy box, where it says buy it with one click, or put it into the cart if it says, here are some other alternative, buying options. They tend to bounce. And they usually only do that when it's a non-competitive price, which is a way for Amazon to punish the seller for not acting competitively, which is a whole nother issue, the issue that the Federal Trade Commission took up. But this has, I think, implications for other retailers as well. I mean, eBay, is the other one that comes to mind. Some of the other retailers starting to open up their own online marketplaces, and so it's a big, I think, retail question is, do these companies have to be considered distributors? And if they are going to be distributors, it's going to make sense for a lot of these retailers to expand into private label more heavily, or even acquire some of these suppliers, or cut some of these suppliers off that are deemed potentially risky. Amazon, for its part, would say that they do take steps to make sure that nothing is suspicious or seems like it's a fake product. And they do say, well, they do have pretty lenient return policies. We can return, pretty much anything to Amazon, and Amazon tracks that as far as holding a third party, responsible. But I think this is a pretty big issue for Amazon going to be a distributor. With a few minutes left, we'll talk about a little bit of Walmart news, which is pretty interesting. That the headline was that Walmart store managers could make up to $404,000 a year. I think that was kind of the attention grabbing headline. You sort of dig into the weeds a little bit, and it's like the base pay is 128. The rest is incentive compensation. Maybe the bigger thing is that the store managers are getting some stock to get them ownership in the company. And Walmart says, I mean, this is a job that's harder than it looks, managing a Walmart superstore. Specifically, you're managing hundreds of employees. There's lots of churn in those employees, and it does seem like that upper end of the range is really kind of a stretch goal. I mean, there were headlines last year that the average Walmart store manager makes about $200,000. So I think $400,000, if they can sort of completely max that out, you probably have to be in the right location, really be a profitable store. But in any event, really kind of follows on nicely to the article that Rachel Premack wrote the other week. That's why do Walmart drivers get paid so well? This is almost like why do Walmart store managers get paid so well as well? They also announced this 5-year growth plan to upgrade a lot of these stores. Maybe makes Walmart less of a dump than it typically would be. Tends to be one that I think a lot of people avoid just because they just don't like going to those stores. And then they also announced a 3-for-1 stock split, which is to get more of their associates on board with acquiring shares themselves and in their own retail accounts. And it's probably something that should have been done sooner. And part of what goes into there is Walmart stock just hit an all-time high. It's very close to an all-time high. It's really performed well with the shift into grocery. But even at a relatively high level, I think their employees could probably do worse than reinvest in their employer. With that, I want to give a little bit of a rundown on some of the things we're thinking about for upcoming episodes of the Stockout. Is some of the things I find interesting in the space is really how retailers and CPG companies can leverage AI and data collected about their customers. That's been a big issue lately, a big sort of alternative revenue source where the retailers can earn a much higher margin if they're selling data collected to their customers. The data collaboration between the retailer and the CPG company, where the CPG company can, let's say, have targeted advertising, to people specifically that are in the habit of buying the competing products, maybe targeting those promotions. If you're selling a protein bar and your Cliff Bar, and you give maybe your bars away for free to people that buy the competitor. I think that's pretty valuable. So really a lot on inventory management using AI to better manage inventory levels, I think is a big topic. A big topic that we're going to touch on also is how shippers should be positioning themselves against a potential turn in the freight market later this year, which you look at some of the increase in the spot rates, like I was showing, the narrowing of the spread between the spot and contract. You think, well, maybe there is a potential turn coming at some point this year. This pandemic era trend of supply chain resilience, sort of just in case, inventory is it really going away? How should a retailer and CPG company think about balancing those two, objectives? And then all the stuff about, sort of where we stand with warehousing capacity now. It seems like that with warehousing, there was always either too much of it or too little of it. During the pandemic, there was warehouses were overstuffed, and then it seemed like we're going to overbuild the warehousing. Now it's come, some of those projects have been canceled because the inventory's got to be a little bit lighter. So, what does inventory say about freight demand? There's also a big, another variable to see with the freight markets is inventory. So there's a lot of, shippers that will say that, it used to be pretty easy. You would look at what the National Retail Federation is expecting for retail sales, and that would tell you exactly what demand is going to be, on the highway or coming off the ports. But the fact that inventories have either been sort of too high or too low, last few years, it's really sort of the last kind of piece to really understand what's happening in the freight market, is to get better data about that. So that's something that we're trying to do here at FreightWaves. Also going to cover the Kroger Albertsons transaction. We'll see if that closes as expected. And then another topic is all these are the ultra processed foods really the boogeyman that they are made out to be. That seems to be the hot topic right now, is to avoid ultra processed foods, which really is most or a large portion of what I would consider consumer packaged goods would fall under that category. So those are some topics that we hope to hit in the coming weeks. Open to hearing about others. And with that, out of time for today, and hope everyone has a good week.